All right, this is Market Acme, and I am Kenzo John AG. I need you to stay with me for the next several minutes because what I'm about to walk you through is not opinion, it's not theory, and it's not another recycled headline you've seen 100 times on financial media. This is about a specific convergence of signals that institutional players are acting on right now, signals that were confirmed in the data released over the last 7 days, and a window of approximately 90 days that separates those who understand what's happening from those who will be caught completely off guard. I'm talking about the US dollar index breaking below a critical psychological level, a major European bank publicly warning that the dollar's safe haven status is being undermined in real time, Federal Reserve officials sending mixed signals that reveal the impossible position they've trapped themselves in, and speculative positioning data that shows smart money is already repositioning for what comes next. This is not a future scenario. This is happening right now, and the acceleration phase is beginning. Let me give you the specific data points that triggered this analysis because I want you to understand that everything I'm about to share is sourced from official releases, institutional reports, and market data that anyone can access, but almost no one is connecting properly. On Monday, February 17th, 2026, the US dollar index held just below 97, moving sideways in thin trading as US markets were closed for the President's Day holiday, and mainland China was shut for the week-long Lunar New Year break. That number 97 might not mean anything to most people watching financial news, but to institutional currency traders and central bank reserve managers, it represents a critical threshold that the dollar has struggled to hold for months. When the dollar index breaks below 97 and fails to recover with conviction, it sends a signal to global markets that the decade-long dollar strength cycle may be entering its terminal phase. But here's what most people missed entirely. On the same day, Deutsche Bank, one of the largest and most systemically important financial institutions in Europe, released an analysis warning that artificial intelligence risks in U.S. equities are actively undermining the dollar's safe haven status. Read that again. A major global bank is telling its institutional clients that the very technology sector that has driven U.S. market outperformance for the last 15 years is now creating systemic risks that threaten the dollar's foundational role in the global financial system. This is not some fringe commentary. This is Deutsche Bank, a primary dealer, a member of the global systemically important banks list, telling the world that the assumptions underlying dollar dominance are being questioned at the highest levels of institutional finance. Now let me connect this to the inflation data that was released last week, because this is where the Federal Reserve's impossible position becomes crystal clear. The annual headline inflation rate slowed to 2.4% in January, down from 2.6% in each of the previous 2 months and below forecasts of 2.5%. On a monthly basis, inflation eased to 0.2%, compared with expectations that it would remain steady at 0.3%. On the surface, this looks like good news. Inflation is cooling, the Fed's policies are working, and rate cuts are coming. That's the narrative you'll hear on mainstream financial media. But here's what they're not telling you. Chicago Fed President Austin Goolsbee said in a Yahoo Finance interview on Friday that the latest CPI report contained both encouraging elements and areas of concern, particularly persistently high services inflation. Those two words, persistently high, are doing a lot of work in that sentence. What Goolsbee is signaling, and this is the institutional communication that most retail investors completely miss, is that the headline number is improving, but the underlying inflation dynamics remain problematic. Services inflation is sticky. It doesn't respond quickly to interest rate policy because it's driven by wages, rents, and healthcare costs, all of which have structural momentum that takes years to reverse. The Fed knows this. They've known it for 2 years. And yet the market is now pricing in rate cuts starting as early as June, with the CME FedWatch tool showing a 52% probability of a June cut and nearly 90% probability that the Fed holds rates steady in March before beginning cuts later in the year. Do you see the trap? The Fed has inflation that isn't fully under control, particularly in services. But the market is demanding rate cuts, and the bond market is pricing them in. If the Fed cuts rates while services inflation remains elevated, they risk reigniting the inflation cycle and destroying what's left of their credibility. If they hold rates higher for longer, they risk triggering a recession, blowing out the interest expense on $36 trillion in national debt, and watching the dollar collapse anyway as the economy weakens. There is no clean path out of this. The Fed has to choose between two forms of damage, and both paths lead to dollar weakness. The only question is the timeline and the severity. Now let me introduce you to a concept that will frame everything else I'm going to share today. It's called the impossible trinity. also known as the trilemma of international economics. The theory states that a country cannot simultaneously maintain all three of the following: a fixed exchange rate, free capital movement, and independent monetary policy. You can choose any two, but not all three. The United States has historically chosen free capital movement and independent monetary policy, which means the exchange rate must float. This has worked reasonably well when the dollar was strengthening or stable because foreign capital flowed into U.S. assets, seeking returns and safety. But we are now entering a period where that dynamic is reversing. The dollar index at 97 is not just a number. It represents the equilibrium point where global capital flows have been balanced between those seeking dollar safety and those seeking better returns elsewhere. When that equilibrium breaks, and I believe we are in the early stages of that break right now, the feedback loops accelerate quickly. Here's the mechanism. When the dollar weakens, foreign holders of U.S. Treasuries experience losses in their local currency terms. This makes U.S. Treasuries less attractive as a reserve asset. As demand for Treasuries declines, yields must rise to attract buyers. Rising yields increase the interest expense on $36 trillion in debt, which accelerates the deficit, which requires more borrowing, which creates more supply of treasuries, which puts more downward pressure on prices and upward pressure on yields. This is a self-reinforcing cycle that becomes very difficult to stop once it gains momentum. Now let me show you what smart money is already doing, because this is where the speculative positioning data becomes critical. According to the latest commitment of traders data released by the Commodity Futures Trading Commission on February 14, 2026, large speculators and hedge funds held a net short position of 729 contracts on U.S. dollar index futures as of February 10th. That represents a decrease of 123 net short positions compared to the previous week. Now, you might read that and think the smart money is becoming less bearish on the dollar, but that's not how you interpret this data. The reduction in short positions during a period of thin holiday trading, when the dollar is consolidating just below a critical support level, suggests that speculators are taking profits on existing shorts before the next leg down, not that they're turning bullish. This is textbook positioning behavior ahead of a major move. When you see net short positions being reduced while the underlying asset remains weak and consolidating below support, it typically means that traders are reloading for the next push lower. They're not covering because they think the dollar is going to rally. They're covering because they want to rebuild capacity to short more aggressively when the next catalyst hits. And what's the next catalyst? The data calendar over the next several weeks includes the latest Federal Reserve minutes, Q4 GDP data, and the Fed Preferred Core PCE Price Index report. These releases will provide further guidance on the monetary outlook, and if they confirm what the CPI data already showed, that inflation is moderating but not fast enough to justify aggressive rate cuts, we're going to see the market reprice expectations rapidly. Here's what I mean by that. Right now, markets are pricing in roughly 2 25 basis point cuts by the end of the year, but Goolsbee and other Fed officials are signaling that services inflation remains a concern. If the core PCE data comes in hot, or if the Fed minutes reveal more hawkish internal debate than the market expects, those rate cut expectations will get pushed out. And when rate cut expectations get pushed out while the economy is slowing, that's the worst possible combination for risk assets. The dollar might get a temporary bounce on hawkish Fed rhetoric, but it will be a dead cat bounce because the underlying fiscal dynamics make sustained dollar strength impossible. The United States cannot run $2 trillion annual deficits, service $36 trillion in debt at elevated interest rates, and maintain a strong dollar simultaneously. The math doesn't work, and eventually the math always wins. Let me give you a historical parallel that illustrates exactly where we are in this cycle, because patterns repeat and the playbook is remarkably consistent across monetary transitions. In 1985, the US dollar had experienced a massive rally that began in 1980. The dollar index peaked at around 164 in February 1985, representing a 50% appreciation over 5 years. The dollar was strong because the Federal Reserve under Paul Volcker had raised interest rates aggressively to crush inflation, attracting massive capital flows into dollar-denominated assets. But there was a problem. The strong dollar was crushing American exporters, widening the trade deficit, and creating political pressure from U.S. trading partners who were seeing their currencies devalue against the dollar. In September 1985, the finance ministers of the United States, Japan, West Germany, France, and the United Kingdom met at the Plaza Hotel in New York and agreed to coordinate intervention to weaken the dollar. This became known as the Plaza Accord. Over the next 2 years, the dollar fell by approximately 50% against the Japanese yen and the German mark. Investors who were positioned in dollar-denominated assets without hedges saw their international purchasing power cut in half. Meanwhile, those who recognized the shift and positioned in foreign currencies, gold, and international assets multiplied their wealth. The parallels to today are striking. We've had a decade-long dollar bull market driven by relative interest rate differentials and capital flows into U.S. assets, particularly technology stocks. The dollar index reached highs above 114 in 2022 and has been in a slow decline ever since. We are now at 97, roughly 15% off the highs, and the structural factors that drove the dollar rally are reversing. The trade deficit remains massive. The fiscal deficit is at crisis levels. The Federal Reserve is trapped between inflation and recession. And our trading partners, particularly China and the BRICS nations, are actively building alternative payment systems and reserve architectures that reduce their dependence on the dollar. This is the Plaza Accord in slow motion, except this time it's not coordinated by central banks. It's being driven by the fundamental mathematics of American fiscal imbalance and the strategic decisions of countries that no longer want to be dependent on a currency controlled by their geopolitical competitor. Now let me talk about what's happening with other currencies, because this is where you can see the dollar weakness in real time. The Australian dollar has extended its rally for a fourth consecutive week against the US dollar. AUD-USD continues its upward trajectory driven by hawkish Reserve Bank of Australia rhetoric, stabilizing commodity markets, and US dollar softness. This is significant because the Australian dollar is a commodity currency. When commodity currencies are strengthening against the dollar, it tells you that global capital is rotating out of financial assets and into real economy exposure. Commodities, energy, materials, agricultural products. These are the sectors that outperform during periods of dollar weakness and inflation. The Reserve Bank of Australia is maintaining hawkish rhetoric, while the Federal Reserve is signaling potential rate cuts. This interest rate differential favors the Australian dollar and creates carry trade dynamics that put additional pressure on the greenback. Smart institutional money can borrow in dollars at lower expected future rates and invest in Australian assets at higher rates, capturing the spread. As more capital flows into this trade, it accelerates the dollar weakness. This is not just happening with Australia, it's happening across the commodity exporting world. The Canadian dollar, the Norwegian krone, the Brazilian real, and currencies tied to real asset production are all showing relative strength against the dollar. This is the market telling you that the dollar's role as the sole safe haven is being questioned. And this brings us back to the Deutsche Bank warning that I mentioned at the beginning. When a major European bank explicitly states that AI risks in U.S. equities are undermining the dollar's safe haven status, they're communicating something profound to their institutional clients. They're saying that the concentration of U.S. equity market value in a handful of technology companies creates systemic risk that extends beyond the stock market into the currency market. Think about the mechanism. Foreign investors have poured trillions of dollars into U.S. technology stocks over the last decade. To buy those stocks, they had to first buy dollars. That created demand for dollars and supported the currency. But if those technology stocks experience a significant correction, whether due to AI-related risks, regulatory pressure, or simply valuation gravity, foreign investors will sell those stocks and convert the proceeds back into their home currencies. That creates a wave of dollar selling that compounds the equity decline. This is the reflexivity that George Soros wrote about. The dollar's strength and U.S. equity market strength have become mutually reinforcing, which is great on the way up but devastating on the way down. A stock market correction triggers dollar weakness, which triggers foreign selling of treasuries, which raises yields, which hurts stock valuations, which triggers more selling, which creates more dollar weakness. The feedback loops accelerate in both directions. So what should you be doing with this information? Let me walk you through the specific positioning framework that institutional investors are using right now, because this is not about panic. It's about strategic preparation. The first move is to reduce your concentration in dollar-denominated financial assets. If more than 80% of your net worth is sitting in U.S. stocks, U.S. bonds, and U.S. bank accounts, you have massive single point of failure risk. You're not diversified. You're concentrated in one currency in one jurisdiction at exactly the moment when that currency is showing structural weakness. The action here is to move a portion of your liquid net worth into assets that benefit from dollar weakness or are neutral to dollar movements. Physical gold and silver are the most obvious choices because they are priced inversely to the dollar. When the dollar weakens, Gold and silver prices rise in dollar terms. This is not speculation. It's mathematical identity. Gold is currently trading around $2,950 per ounce. Silver is around $30. These prices do not reflect a world where the dollar loses 20% or 30% of its value over the next 2 to 3 years. If we see a dollar decline similar to the post-Plaza Accord period, gold could easily reach $4,000 to $5,000 per ounce, and silver could reach $50 to $75. The key is physical metal, not paper claims. During periods of currency stress, paper claims on gold and silver, including ETFs and unallocated accounts, carry counterparty risk that physical metal does not. You want metal in your possession or in fully allocated segregated storage with a reputable custodian. The second move is to reduce duration in fixed income. If you're holding long-term bonds, 10-year treasuries, 30-year treasuries, corporate bonds with extended maturities, you are exposed to significant interest rate risk. When inflation proves stickier than expected and the Fed is forced to delay rate cuts, long-duration bonds get crushed. When yields rise even 50 basis points, a 30-year treasury can lose 10% or more of its value. The action here is to rotate into shorter duration instruments or exit fixed income entirely and move into real assets. Treasury inflation-protected securities can provide some hedge against inflation, but they still carry dollar risk. The safest fixed income position in this environment is short duration or no duration at all. The third move is to build positions in commodity producers and international equities. If the dollar is weakening and commodities are strengthening, the companies that produce those commodities will see expanding margins and increasing cash flows. Energy companies, mining companies, agricultural producers. These are the sectors that will outperform as the monetary transition accelerates. Look specifically at gold and silver miners with low all-in sustaining costs. These companies have operating leverage to the metal price. If gold goes from $2,950 to $4,000, a miner with costs of $2,200 per ounce sees their margin go from $1,750 to $2,800, a 60% increase in profitability. That kind of operating leverage can drive share prices significantly higher, potentially 3 to 5 times current levels in a sustained gold bull market. The fourth move is international diversification. This means holding some assets in currencies and jurisdictions outside the United States. The Swiss franc and Singapore dollar are traditional safe haven currencies with strong rule of law and stable monetary policy. Holding a portion of your wealth in these currencies provides a hedge against dollar-specific risks. Additionally, holding real assets in foreign jurisdictions, whether that's real estate, precious metals in international storage, or equity positions in foreign markets, creates structural protection that domestic-only holdings cannot provide. If capital controls or emergency measures are ever implemented in the United States during a currency crisis, and history shows this is not as unlikely as people think, assets held offshore in your name are significantly more difficult to access or freeze. Now let me address something that I know some of you are thinking. You might be wondering whether this analysis is too bearish, whether the dollar has survived challenges before and will survive this one, whether the United States is still the strongest economy in the world with the deepest capital markets and the most liquid currency. All of those things are true, and none of them mean that the dollar can't lose 20% or 30% of its value over the next several years. In fact, the dollar has lost far more than that in previous cycles without the United States collapsing or losing its position as a major economic power. Between 1985 and 1987, the dollar fell 50% against major currencies. Between 2001 and 2008, the dollar fell approximately 40%. In both cases, the United States remained the world's largest economy, the dollar remained the primary reserve currency, and American life continued. But investors who were concentrated in dollar-denominated assets without hedges experienced significant purchasing power destruction. This is not about predicting the end of America or the collapse of the dollar as a functioning currency. This is about recognizing that we are in a period of structural dollar weakness, that the Federal Reserve is trapped in an impossible position, that major institutions are publicly warning about dollar safe haven risks, and that smart money is already positioning for what comes next. The question is not whether you believe the dollar will decline. The question is whether you're positioned to protect and grow your wealth if it does. The asymmetry is heavily in favor of preparation. If you diversify into gold, commodities, and international assets, and the dollar remains stable, you'll still earn reasonable returns on quality assets. But if the dollar weakens significantly and you're not diversified, you could lose 30% or 40% of your purchasing power in real terms. The risk-reward calculation strongly favors action, and the window for that action is closing. The Federal Reserve meets in March, and the market will be watching for any hints about the rate cut timeline. The core PCE data will provide the next read on inflation. Q4 GDP will show whether the economy is maintaining momentum or rolling over. Each of these data points has the potential to accelerate the trends that are already in motion. Here's what I want you to do right now. First, I want you to assess your current dollar exposure honestly. Add up everything you own that is denominated in US dollars, stocks, bonds, bank accounts, retirement accounts. Then calculate what percentage of your total net worth that represents. If it's above 75%, you have concentration risk that needs to be addressed. Second, I want you to start building a position in physical gold and silver. You don't have to do it all at once. Dollar cost averaging over the next 3 to 6 months can smooth out price volatility, but start now, while prices are still reasonable relative to the monetary dynamics that are developing. Third, I want you to subscribe to this channel and turn on notifications because I'm going to be covering the Federal Reserve meetings, the inflation data releases, and the currency market developments in real time as this situation evolves. This is not entertainment. This is actionable intelligence that will help you navigate what could be one of the most significant monetary transitions of our lifetime. Fourth, I want you to share this video with anyone you know who has significant wealth in traditional dollar-based assets and hasn't thought carefully about currency risk. Most Americans assume the dollar is stable because it's all they've ever known. They don't realize that the dollar's purchasing power has declined by over 95% since the Federal Reserve was created in 1913, or that there have been multiple periods in their own lifetimes when the dollar lost 30% or more of its value against other currencies and real assets. The people who will be hurt most by this transition are the ones who assume the current system will continue indefinitely, who trust institutional reassurances without reading the actual data, and who won't take action until the headlines confirm what the indicators have been showing for months. Here's the question I want you to answer in the comments because this helps me understand where this community is and what topics I should prioritize in future videos. What percentage of your current net worth is in physical gold and silver, and what is the single biggest obstacle preventing you from increasing that allocation? Is it skepticism about the thesis? Is it uncertainty about where to buy and how to store? Is it simply competing priorities for your capital? Let me know because I want to address the real barriers that people face, not hypothetical objections. The dollar index is at 97. Deutsche Bank is warning about safe haven risks. The Federal Reserve is trapped between sticky inflation and market expectations for rate cuts. Speculative positioning shows smart money is preparing for the next leg lower. The Australian dollar and other commodity currencies are rallying, and the structural fiscal dynamics of the United States make sustained dollar strength mathematically impossible. These are not opinions. These are facts that you can verify from official sources. The only question is what you're going to do with this information. You can ignore it and hope that the institutions that created this mess will somehow fix it without consequences for your wealth. Or you can recognize the pattern, understand the timeline, and position yourself on the right side of the transition before the window closes. The choice is yours, but the clock is ticking. I'll see you in the next video.